The pros know that we need to get down to 120, 100, even 85, whatever, maybe a couple negative statistics as some have called for in a presumed slowdown. But what's the unemployment rate that makes Chairman Powell sit up straight?
Well, it's one that starts to rise. He said it in...
It's a vector. It's not so much the level.
It's the change that has to start showing the tightness in the labor market, or the tightness of the labor market beginning to ease, and getting some increases in the unemployment rate. He said it in the press conference that, part of what is the price to pay for achieving success on inflation is a rate of growth that is for a small period of time or a temporary period of time below trend. Well, that's what it'll start to look like in the labor report in a rising unemployment rate, and nothing in this report really points to any of that.
So do you think that the market is overpricing the boogeyman of some sort of crisis or cracks or something to sort of cause this to halt in its tracks and reverse in some sort of meaningful way?
So let's separate the market pricing of what is a boogeyman. I think the market worries about tail risk, shock events, crises. And look, the banking sector crisis that we saw in March and a little bit of a echo rebound that we've seen this week is that kind of thing. But that's very different than kind of fundamental economic performance. And that's not so much a tail risk. That's really much more about the trajectory. Now, the two can be linked, obviously, because if you have a crisis, that feeds back into confidence and that hits the economy.
But this creates a real issue. And I'm wondering why we're not seeing it, frankly, in longer-term Treasury yields a little bit more, and whether this is something you're thinking about. Because if you have this push-pull, and perhaps the Fed not being as aggressive as people thought that they would be just based on the economic projection, then isn't the risk of inflation remaining high for a longer period of time that much greater and not being priced in?
Yeah, and it's the pricing in of that should be the term premium, right? There should be a premium for holding longer dated maturities because you have more inflation risk and inflation uncertainty. And that's the disconnect here. The market is really wedded to this view that we go very rapidly back down to a pre-COVID 2% inflation rate. And today's data is just kind of another piece of evidence that says that's not what we're really seeing in the economy yet. So the disconnect between what the Fed has been saying, what Powell said earlier this week in terms of a lot more cautionary tale relative to what you see in the yield curve, the inversion, the lack of a term premium that your question was just asking about, that's very much still the tension that we're dealing with.